Is it truly possible to beat the stock market? Or is it, ultimately just a matter of chance, maybe a bit of skill for a lucky few? This isn't just some academic question, right? It's really at the core of every investment decision you make.
Absolutely.
And it's the profound puzzle we're diving into today.
It really is. It's one of the most fundamental debates in finance, actually.
Right.
It goes back over a century.
Yeah.
And it directly challenges the intuition, that gut feeling many of us have about investing.
Which says
That with enough smarts or enough hard work, you can outwit the market. You can find that edge.
right, that you can beat the averages. And the central concept holding this whole discussion together is something called the efficient market hypothesis, or EMH for short.
Yeah, EMH.
Yeah.
It's a theory that proposes a very specific view of how prices behave and, crucially, what that means for investors like you. It sounds simple on the surface, maybe.
But it's powerful.
Incredibly powerful. And it's been tested, challenged, debated relentlessly over the years.
That's right. And we've got quite a stack of sources here, foundational research papers, later studies that really shook things up, historical accounts, even some modern takes, all aimed at helping us unpack this.
So what's the plan?
Our mission, to pull out the most important nuggets, the surprising facts, the core insights from all this material. We really want to help you become truly well-informed.
Not just on the definition.
Exactly. Not just what EMH is, but where did it come from? What does the evidence really say, both for and against it? And maybe most importantly, what does this whole deep dive mean for your own investment strategy?
Think of it like exploring a landscape. A landscape mapped out by some pretty complex theories and lots of empirical data.
Yeah.
We'll journey from the very first hints of this idea, trace how the formal hypothesis developed, look closely at those unexpected the anomalies that seem to poke holes in it,
Right.
and then try to see what conclusions we can draw for you, the modern investor, today.
Okay, sounds like a plan. Let's start right at the beginning then, with that core idea. What exactly is market efficiency as this collection of sources defines it?
Well, at its most basic level, the material we're looking at defines market efficiency primarily as informational efficiency.
Informational efficiency, okay. Meaning?
It means that the price of a financial asset, could be a stock, a bond, whatever, immediately and fully reflects all relevant available information.
Relevant information. That sounds broad. What does that actually cover?
It really can be anything that might affect the value of that asset. So company earnings reports, obviously, news about a new technology, changes in interest rates, even political events,
Anything that matters.
Anything that matters, exactly. The key idea is that as soon as information becomes public, or even just available to a significant number of market participants, they react. They trade based on that news. And their collective actions, buying and selling, push the price very quickly to reflect the new fair value, incorporating that piece of information.
Okay, so let's say some fantastic news comes out for Company X. You wouldn't expect the stock price to just sort of gradually creep up over days or weeks as people slowly figure it out.
Nope. Theoretically, if the market is efficient, it should jump almost instantly, or at least adjust very, very rapidly.
Why so fast?
The driving force is competition. Markets, especially major ones like the U.S. stock market, are incredibly competitive. You've got armies of analysts, fund managers, individual investors, all trying to get an edge, trying to get an act on information faster than the next person.
Right. Everyone wants to be first.
And that very competition ensures that new information gets baked into prices with remarkable speed.
Okay. Now, the sources also briefly mentioned something called operational efficiency. How's that different from the informational efficiency we're focusing on?
Good question. Operational efficiency is more about the mechanic of the market itself. How smooth and low cost is the process of actually buying and selling.
Like transaction fees, how fast orders go through.
Exactly. Are transaction fees high or low? How quickly can your buy order get executed? Is it easy to find someone to take the other side of your trade? That's operational efficiency. And while it's definitely crucial for a well-functioning market,
Sure.
the core EMH debate, the one we're really digging into, centers on whether prices correctly reflect value based on information. That's informational efficiency. Our material definitely leans heavily into that side of things.
Got it. So focus on information and the price happening quickly. And if markets are informationally efficient in this way, what's the huge implication, the big takeaway for anyone trying to make money investing?
The core implication. The bombshell really dropped by this hypothesis is this. In competitive, efficient markets, You shouldn't be able to consistently earn excess risk-adjusted returns.
Excess risk-adjusted returns, meaning?
Meaning you can't consistently beat the market just by using available information or common strategies. Any higher return you happen to get should, according to the theory, simply be fair compensation for taking on higher risk, not because you outsmarted everyone.
Wow. Okay, that's a pretty bold statement. It basically implies that all the hours you might spend poring over balance sheets, reading financial news, studying price charts, might not actually give you a consistent edge over just, say, buying an index fund.
It certainly challenges the very foundation of active investment management. The whole industry built on the idea that skilled professionals can pick winners or time the market to outperform.
It really does.
But to understand why this hypothesis took such strong root, why it became so influential, we really need to trace its origins.
Yeah.
Because they're kind of unexpected.
Okay, let's do that. Rewind the clock. Where did this pretty counterintuitive idea first pop up? The idea that prices are hard to predict because they already reflect information so well?
We have to go back, way back, actually, surprisingly far. Paris, France, the year 1900.
1900, wow.
Yeah. There was a French mathematician, Louis Bachelier. He was working on his PhD dissertation at the Sorbonne. His topic was the mathematical theory of speculation. Specifically, he was looking at options on French government bonds, basically commodity options at the time. A mathematician studying financial markets over 120 years ago, that's really early for quantitative finance ideas. It was incredibly pioneering. Bachelier was watching prices, analyzing them mathematically, and he realized something profound. He noticed that while the current price, past prices, even sort of discounted expectations about the future, were all reflected in the price level.
Okay.
The changes in price from one moment to the next seemed to have, in his words, no apparent relation to past changes.
No apparent relation. You mean like they were random, unpredictable?
Precisely. He concluded that price changes were essentially unpredictable based on past changes. His mathematical work was brilliant. He actually developed equations that anticipated the formal description of Brownian motion.
Brownian motion, like the random movement of particles, the thing Einstein worked on.
The very same. Einstein published his famous paper on it 5 years later in 1905. Bachelor's work was there first, applied to finance. But unfortunately,
what happened?
Got buried, lost in the mathematics literature. Economists, financiers, they largely ignored it or just didn't know about it for decades. It wasn't until Paul Samuelson circulated it and Paul Kuttner published an English translation in the 1960s that it got wider recognition.
So the seed was planted very early, but it didn't germinate right away in the world of finance. What happened next on this journey towards EMH?
Well, the idea sort of resurfaced, but this time through empirical observations.
Yeah.
People started looking at actual market data more rigorously, especially as early computational tools became available in the 1930s and onwards.
Who was doing this?
Researchers like Holbrook, working in 1934, and Alfred Cowles and Herbert Jones in 1937, both in the U.S. They examined various series stocks, commodities, and they noticed these random characteristics. Patterns that looked surprisingly unpredictable, much like Bachelier had suggested mathematically.
And Alfred Cowles III, he comes up again here, right? The founder of the Cowles Commission, known for that rigorous economic research.
Yes, absolutely. Cowles did some particularly interesting early work. Back in 1933, and then he updated it in 1944, he undertook these really painstaking analyses. He looked at thousands and thousands of stock recommendations made by professional investment managers and financial services over long periods.
What was he trying to find out?
He wanted to see if they actually delivered on their promise, could they consistently beat the market. His findings were quite startling for the time.
And they were.
He concluded there was, and I quote, no discernible evidence that these professionals could consistently outguess the market over the long haul.
Wow. So decades before FAMA formalized EMH, Cowles had data suggesting the experts weren't consistently outperforming random chance or the market average.
Pretty much. It was early, scattered evidence, pointing towards what we'd later call weak form and even strong form efficiency, long before anyone used those terms.
Fascinating. Did this line of inquiry continue?
It did. The research picked up again in the 1950s, with better statistical techniques. Maurice Kendall, a British statistician, studied historical UK stock and commodity prices. He was actually expecting something different.
What did he expect?
He thought he'd find clear, predictable cycles or trends, patterns that could be exploited.
But he didn't.
No, he was quite surprised by what he found. He concluded that the period-to-period random changes were just so large as to swamp any systematic effect which may be present.
So the noise drowned out any potential signal.
That's a good way to put it. He famously said the data behaved almost like wandering series. This was really puzzling for economists back then, who intuitively felt that market prices should be somewhat predictable, based on underlying economic value or historical patterns.
Wandering series, that sounds a lot like the term we still use today.
Exactly. It leads directly to the iconic label, the random walk.
Where did that term come from?
Well, the term itself was actually popularized in a scientific context earlier by Carl Pearson in 1905. He used this vivid analogy of the unpredictable path of a drunkard staggering away from a lamppost. Each step is random, unrelated to the last one.
Right.
That term, random walk, was then applied to financial price series, where successive returns seem to be independent. Knowing today's price change doesn't help you predict tomorrow's price change. Eugene Fama later gave it a more formal definition in his 1965 work.
Okay, so the evidence is building that prices behave randomly. This must have been a direct challenge to certain ways of investing, right? Like technical analysis.
A huge challenge, especially for technical analysts who try to predict future prices by looking for patterns in historical price charts and trading volumes.
Because if it's random...
If it's truly random, like flipping a coin, then studying past flips tells you nothing about the next flip. Harry Roberts, in a key paper in 1959 aimed squarely at financial analysts, made this point dramatically. He showed graphs, side by side. One was actual U.S. stock prices over time. The other was a time series generated purely by random numbers. His point was stark. They look incredibly similar, indistinguishable to the naked eye.
Ouch. So the patterns technicians thought they saw might just be illusions, random noise?
That was precisely his argument. If prices truly behave like random numbers, then trying to find predictive patterns in historical charts is basically futile. It's like trying to find a secret message in a string of random coin flips.
Got it.
And interestingly, around the same time, you had a physicist, MFM Osborne, looking at stock prices from a completely different angle.
A physicist?
Yeah. He saw analogies between the random movement of stock prices and the random motion of molecules in physics. He actually applied concepts from statistical mechanics to try and understand stock price behavior.
So you've got mathematicians, economists, statisticians, physicists, all independently converging on this idea that prices seem to have this strong random component.
The evidence was really mounting from different disciplines. There was a slight wrinkle initially. Some early studies did find tiny correlations between past and future returns, suggesting maybe a little predictability.
So not perfectly random.
Well, it turned out that researchers, like Working Again and also Alexander, independently figured out in the early 1960s that this apparent predictability was often just an artifact of how the data was measured.
How so?
If you used prices that were averaged over a period, like weekly averages, it could mathematically induce a small correlation. But when they used specific point-in-time prices, like end-of-day closing prices, those correlations largely disappeared. The random fluctuations became much clearer.
So the details of data handling matter a lot.
They really do. And this distinction actually touched upon early ideas about what we now call market microstructure, how the nitty-gritty mechanics of trading itself can affect the prices we observe.
Fascinating. So by the mid-1960s, where did things stand?
By the mid-60s, all these scattered pieces of empirical evidence were really coming together. Paul Kuttner published that important collection of early papers in '64, bringing Bachelier and others to wider attention. And then the big one, 1965, Eugene Fama published his hugely influential doctoral dissertation.
Fama again?
Yes. He reviewed all this prior work, added his own extensive empirical analysis of stock prices, and reached a strong conclusion. He stated there was strong and voluminous evidence in favor of the random walk hypothesis. This really set the stage for the formal theory of effusion markets.
Okay, so we have this growing pile of evidence from multiple angles suggesting prices seem to follow a random walk. They're hard to predict from past prices. But the why was still maybe a bit fuzzy. Why, theoretically, should prices behave this way?
That's exactly the question Paul Samuelson tackled, the Nobel laureate economist. In 1965, the same year as Fama's dissertation review, Samuelson published a crucial theoretical paper.
And the title was quite something, wasn't it?
It was. Proof that properly anticipated prices fluctuate randomly. Kind of gives the game away, right?
It really does. So what was his core argument? How did he prove it?
His logic was elegant and really powerful, he asked. Imagine a well-functioning competitive market. What would happen if everyone knew, based on current information that a stock's price was definitely going to rise predictably tomorrow.
Well, everyone would want to buy it today to capture that guaranteed profit.
Precisely. They'd rush to buy today. That surge in demand would instantly drive the price up today, right up to the point where that expected future rise is completely gone. It gets incorporated into today's price immediately.
The predictable profit opportunity vanishes because everyone tries to grab it at once.
Exactly. That's the concept of arbitrage at work. Samuelson argued that if future price changes were predictable based on currently available information, sharp-eyed traders, arbitrageurs seeking easy, risk-free profits would immediately exploit that predictability.
And their actions would.
Their buying or selling would instantly push the price to a new level where their predictability is eliminated. Poof, gone. Therefore, he reasoned, for prices in a competitive, rational market, to be fair, future price changes must be unpredictable based on current information. They have to fluctuate randomly.
So the random walk isn't just some weird statistical quirk, it's the necessary outcome of rational, competitive traders acting on information.
That's the theoretical breakthrough Samuelson provided. It explained why those random patterns observed empirically should actually exist in efficient markets.
Okay, that connects the dots. And this is where Fama comes back in to synthesize everything.
Yes. Building on Samuelson's theoretical foundation and all the prior empirical work, Eugene Fama, in his landmark 1970 review paper, formally laid out the efficient capital markets hypothesis. He gave it structure.
How did he structure it?
He proposed 3 distinct forms, or levels of market efficiency. The key difference between them is what kind of information is assumed to be fully reflected in the current stock prices.
Okay, 3 levels. Let's break them down. What's the first, the most basic level?
The base level is called weak form efficiency. This hypothesis states that current stock prices fully reflect all information contained in past prices and historical trading volume data. Nothing more, just the history of the price itself.
So if weak form efficiency holds true, looking at charts, looking at past price movements, looking at trading volume patterns, none of that gives you an edge.
That's the implication. If the market is weak form efficient, then technical analysis trying to predict future price movements by identifying patterns in past price and volume data cannot consistently generate excess risk-adjusted returns. Why? Because all the information contained in that past sequence of prices is supposedly already baked into the current price.
Got it. Past trading data is already in the price. What's the next step up in efficiency?
That's the semi-strong form efficiency. This makes a much stronger claim. It says prices reflect all publicly available information.
Publicly available. So not just past prices, but everything else you could possibly find out about a company or the wider economy.
Pretty much everything that's out there in the public domain. Financial statements, earnings announcements, news headlines, press releases, economic reports, analyst recommendations, merger news, regulatory filings, you name it.
Wow. Okay, so if markets are semi-strong efficient, what does that imply for investors?
It implies that fundamental analysis is more the deep dive into a company's financials, its management quality, its industry position, the economic outlook, all that stuff, to estimate its true value, also cannot consistently generate excess risk-adjusted returns.
Why not?
Because, according to the theory, as soon as that information becomes public, the market reacts instantly and the price adjusts fully to reflect it. By the time you read the news or analyze the financial statement, the price already reflects that information. The opportunity is gone.
You're incredibly fast. How do researchers even test something like semi-strong efficiency in the real world?
A very common method is called an event study. Researchers look very closely at how stock prices behave in a very narrow window of time hours, even minutes, right around the moment a specific piece of public information is announced.
Like an earnings surprise or a merger announcement?
Exactly. Or a stock split announcement. If the price jumps almost immediately to fully reflect the news, say, jumping up on unexpectedly good earnings and then staying there, not drifting further, that's considered evidence supporting semi-strong efficiency.
And have they found that?
Yes. Numerous event studies have shown very rapid price adjustments to news. A famous early one, back in 1969 by Foma himself, along with Fisher, Jensen, and Roll, looked at stock splits. They found the market anticipated the information and prices adjusted almost instantaneously when the split was formally announced.
That makes a lot of intuitive sense, actually. If you've got thousands of analysts and traders glued to their screens waiting for news,
they're going to hit the buy or sell button pretty fast.
Right. Okay, so weak form deals with past prices, semi-strong with all public info. What's the highest, most extreme level of efficiency?
That's the strong form efficiency. This is the most ambitious, the most demanding claim of all. It posits that stock prices reflect all information, not just public information, but private or inside information as well.
Whoa. Okay, so under strong form efficiency, even someone trading illegally on confidential inside information wouldn't be able to consistently make abnormal profits.
That's the theoretical claim.
That seems like a really, really high bar. I mean, we have laws against insider trading for a reason, right? People clearly try to profit from non-public info.
It is an extremely high bar, and generally the consensus, even among EMH proponents based on the sources, is that markets are not perfectly strong form efficient. The very existence and prosecution of insider trading suggests that private information does have value and isn't always immediately reflected in prices.
Makes sense.
However, and this is interesting, some of the early empirical studies back in the 1960s and 70s, while finding broad support for weak and semi-strong forms, also found some results that were surprisingly consistent with versions of strong form efficiency.
How so?
When they looked at the aggregate performance of professional investors, like mutual fund managers, who you might think have access to better analysis or maybe even borderline private information, they generally struggled to consistently outperform the market averages after costs.
Back to the Cowles finding almost.
Yeah.
Even the pros weren't reliably winning.
Exactly. It suggested that even if perfect strong form efficiency wasn't true, the market might be efficient enough that even supposed experts couldn't consistently exploit any informational advantages they might have had.
Okay, so to sum up this phase, the initial empirical work from the 60s and 70s, framed by Fama's three forms, seemed to paint a picture of markets, especially the big U.S. market, being pretty darn efficient. Maybe not perfectly strong form efficient, but certainly leaning towards weak and semi-strong efficiency.
Yes, that was definitely the prevailing view for quite a while. EMH became a cornerstone, really, of modern financial theory and influenced a lot of practice, like the rise of index funds.
But, science and research never really stand still. People keep digging, keep analyzing new data. Did this relatively neat picture of highly efficient markets hold up perfectly as more and more research was conducted in the following decades?
Not entirely, no. Despite that strong initial support, researchers gradually started uncovering things, patterns, regularities in market data, that just weren't easily explained by the strict efficient market hypothesis, especially the semi-strong form.
Patterns that shouldn't exist if prices always reflected all public info instantly.
Exactly. These patterns became more prominent, or at least more widely documented and debated, starting mainly in the 1980s. They came to be known collectively as market anomalies.
Yeah, anomalies.
Yeah.
Like glitches in the matrix of efficient markets, things that just didn't seem to fit the standard model.
That's a good way to think about it. They were statistical regularities, or seemingly persistent patterns in stock returns, that appeared to offer the potential for earning abnormal profits. Profits higher than seemed warranted by the risk involved, at least according to the standard models of the time.
What was the standard model for risk back then, usually?
Mostly the capital asset pricing model, or CAPM. It basically said the only risk that matters for expected returns is systematic market risk, measured by a stock's beta.
Beta, that's how much a stock tends to move up or down with the overall market, right? Higher beta means more market risk, so you should expect a higher return.
Correct. The anomaly suggested you could potentially get higher returns without a correspondingly higher beta, or maybe based on some characteristic completely unrelated to beta.
Okay, so what were some of the most significant anomalies people found?
Two of the biggest, most studied ones related to fundamental characteristics of the stocks themselves: value and size.
Value and size, let's unpack those. What's the value anomaly?
Well, back in 1977, Sanjoy Basu published a study looking at stocks based on their price-to-earnings ratios, or PE ratios. He found that stocks with low PE ratios, often called value stocks because they looked cheap relative to their earnings, tended to systematically outperform stocks with high PE ratios, the growth stocks.
So simply buying the apparently cheaper stocks worked better on average.
According to his findings, yes. And he interpreted this directly as evidence of market inefficiency. It seemed like the market was consistently underpricing these low PE value stocks and overpricing the high PE growth stocks.
Okay, that's value. What about the size effect?
That came a few years later in 1981. Rolf Banz documented what became known as the small firm effect. He looked at a huge data set of NYSE stocks going way back, from 1931 to 1975.
And he found?
He found that stocks of companies with smaller market capitalizations, small cap stocks, had significantly outperformed stocks of large cap companies over that long period. And crucially, this outperformance seemed to persist even after attempting to adjust for risk using the standard beta measure from CAPM.
Whoa, a persistent advantage just for being small. That sounds like a major crack in the EMH facade.
It was seen as a very big deal. It triggered a huge amount of follow-up research, confirming the effect not just in the US over different periods, but internationally as well.
So both value, like low PE, and size, being small, seem to be linked to higher average returns than the standard model predicted.
Exactly. And this research really culminated in many ways in a highly influential paper published in 1992 by none other than Eugene Foma and his collaborator Kenneth French.
Foma again. But wasn't he the father of EMH? Now he's documenting anomalies?
Well, yes and no. They weren't necessarily saying the market was inefficient. What they did was show, quite powerfully, that two factors, company size, market capitalization, and the ratio of a company's book value to its market value, book-to-market equity, another key value metric, did a remarkably good job of explaining the differences in average stock returns across various portfolios between 1963 and 1990.
Better than beta alone.
Much better. They found that size and book-to-market together captured a lot of the variation in returns that beta couldn't explain. In fact, they found that once you accounted for size and value, beta seemed to have very little additional power to explain return differences in their data set.
Yeah.
They even showed these two factors subsumed the PE effect Bossu found, and also effects related to leverage.
Okay, so Fama and French confirmed that size and value were strongly related to historical returns. How did they interpret this? Did they conclude the market was inefficient after all?
This is where it gets really interesting. It leads directly into one of the central problems in interpreting any market anomaly. Fama and French themselves presented two main possible interpretations.
Possibility one.
Possibility one was that the market is efficient, but the standard model, CAPM, is wrong. They argued that size and book-to-market aren't necessarily signs of mispricing, but instead might be acting as proxies for underlying systematic risk factors that aren't captured by beta alone.
So maybe small stocks and value stocks are just fundamentally riskier in ways CPM doesn't measure, and their higher average returns are simply fair compensation for bearing that extra unmeasured risk.
Precisely. In this view, it's not an inefficiency, it's just a more complex risk story. This became the foundation for their famous Fama-French three-factor model, which adds size and value factors alongside the market beta factor.
Okay, that's one interpretation. It's risk, not inefficiency. What was the other possibility they acknowledged?
The other possibility they discussed was that, yes, maybe these effects do represent market inefficiencies. Perhaps the patterns arise from market participants systematically overreacting or underreacting to information, leading to mispricings related to size and value characteristics.
So they left the door open to inefficiency, but leaned towards a risk-based explanation.
Their work definitely spurred more research into multi-factor risk models, but the debate about whether size and value represent risk or mispricing continues to this day. It highlights that central challenge, the joint hypothesis problem.
We'll definitely come back to that joint hypothesis problem. But first, were there other types of anomalies people were finding besides size and value?
Oh, yes. A whole different category involved seemingly predictable seasonal patterns in returns. Things that seemed linked to the calendar, not just company characteristics.
Seasonal patterns? Like what?
The most famous and probably most studied is the January effect. Researchers like Rosef and Kinney, Keim, and later Haugen and Lakonishuk documented this tendency for average stock returns, especially for small cap stocks, to be significantly higher in January than in other months of the year.
Higher returns just because it's January. That feels deeply weird and non-random. How could that fit with efficient markets?
It certainly seems counterintuitive to EMH. The explanations often revolve around things like tax loss, selling pressure, depressing prices of losers, often small caps, at the end of December, followed by buying pressure as the new year begins. But the persistence and size of the effect were puzzling.
Were there other calendar quirks?
Yep. Studies found evidence for other seasonals too. Things like a week of the month effect, patterns related to holidays, and famously, the day of the week effect, often called the weekend effect.
The weekend effect.
Yeah, researchers like French and Harris found that, historically, average returns on Mondays tended to be significantly lower, sometimes even negative, compared to other days of the week. It was as if bad news accumulated over the weekend and hit the market on Monday morning.
So predictability based purely on what day it is. These anomalies really do seem to pile up and challenge that core EMH idea that all available information is already smoothly reflected in prices, right?
They absolutely do. On the surface, they suggest pockets of predictability that shouldn't exist if markets were perfectly efficient. However, just like with size and value, interpreting these seasonals is tricky. Well, some, like the January effect, might have plausible links to institutional factors like tax trading. Others might be related to specific asset pricing phenomena we don't fully understand, or even quirks of market microstructure, how the mechanics of trading differ at the beginning of the week versus the end or the start of the year. And some might just be statistical flukes that don't persist.
Okay, so value, size, seasonal patterns, any other major categories of anomalies? What about patterns over longer time horizons?
Yes, there were significant findings there too. One persistent puzzle relates to the long-run performance of new issues, companies doing their initial public offering, or IPO.
IPOs. Usually lots of hype around those.
Exactly. But studies by researchers like Jay Ritter and later Lofren Ritter found something quite different. They show that, on average, companies that had recently gone public significantly underperformed comparable benchmarks over the 3 to 5 years after their first trading day.
They underperformed. That seems totally counter to the excitement and often high initial valuations of IPOs. Why would that happen?
It's a big puzzle, often called the new issues puzzle. Theories range from issuers timing IPOs when their prospects are temporarily high, to investors getting overly optimistic initially, only to be disappointed later. But the pattern seemed quite robust over long periods.
Interesting. What else in the long run?
Another major finding, related conceptually to the value effect perhaps, is mean reversion in stock prices over longer horizons.
Mean reversion. Prices reverting back to some average level.
Kind of. The seminal paper here was by DeBont and Thaler in 1985, titled, "Does the Stock Market Overreact?" They looked at stocks that had been extreme winners or extreme losers over past periods of 3 to 5 years. They found that the portfolios of past losers, the stocks that had performed terribly, tended to subsequently outperform the portfolios of past winners over the next 3 to 5 years, and vice versa.
So buying the Dodds and selling the Darlings seemed to work on average over these multi-year cycles.
That was their finding. It implied that the market might systematically overreact to past news, pushing prices too far in one direction, either up or down. And these extreme movements tend to be corrected or revert back towards a more fundamental level over longer periods. Porterba and Summers also found evidence consistent with long-horizon mean reversion.
This sounds like strong evidence against efficiency, suggesting prices deviate significantly from fundamental value and only slowly correct.
It was definitely presented as such. However, like many anomalies, the sources note that the statistical robustness and consistency of these long-term mean reversion patterns have been debated, particularly across different time periods and markets. Detecting it reliably is statistically challenging.
Okay, so summing up this section on anomalies, we have value effects, the small firm size effect, various seasonal patterns like the January effect, the long-run underperformance of IPOs, and evidence for long-run mean reversion or overreaction. Taken together, this seems like a pretty significant pile of evidence suggesting markets aren't perfectly efficient in the way the early EMH proposed.
They absolutely presented serious cracks in that original, rather clean facade of the strict efficient market hypothesis. They showed that market behavior was potentially more complex and maybe less rational than the initial theory assumed. And they spurred decades of intense research and debate trying to understand them.
Right. We've laid out all these fascinating anomalies, value, size, January effect, IPOs, mean reversion, that seem to suggest markets aren't perfectly efficient. But you mentioned earlier, especially when discussing Fama and French's work on size and value, that interpreting these isn't always straightforward.
Exactly.
And this brings us back to that critical concept you flagged, the giant hypothesis problem. Can you unpack that for us? Why does it make it so hard to be sure if an anomaly is really proof of market inefficiency?
Okay, the joint hypothesis problem. It's absolutely fundamental to this whole debate, and the sources hammer this point home. Here's the issue. Whenever you test for market efficiency, meaning you test whether prices fully and correctly reflect available information, you are never just testing that one hypothesis alone.
What else are you testing at the same time?
You are simultaneously testing whether the asset pricing model you're using to define normal or expected returns is actually the correct model. You simply cannot test market efficiency in a vacuum independent of a model, of expected returns.
Oh, okay. Let me see if I did this. So imagine you find a strategy, let's say buying small cap stocks, and it consistently earns higher average returns than your benchmark model, like the CAPM using just beta, predicts it should.
Right. You find this abnormal return.
The joint hypothesis problem says there are two possible explanations for that finding, and you can't easily tell which one is right just from the data itself.
Precisely. Possibility number one, the market is inefficient. The small cap effect is a genuine anomaly, a systematic mispricing that allows you to earn true abnormal profits, beating the fair return.
Okay, that's the inefficiency explanation. What's possibility two?
Possibility number two, the market is actually perfectly efficient, but your model for expected returns, the CAPM in this case, is wrong or incomplete. The factor you found being a small cap stock isn't the source of inefficiency. It's actually a proxy for a genuine risk factor that the simple CAPM beta wasn't capturing.
So in this second view, the higher return you observed for small caps isn't abnormal at all.
Exactly. It's just the fair, normal compensation investors demand for bearing in this additional dimension of risk that your initial flawed model didn't account for. The market is efficiently pricing this extra risk, and you just needed a better model to see it.
Wow. Okay. So every time someone claims to have found an anomaly, a pattern of returns that looks abnormal according to their chosen model, it could just mean their model for defining normal was the thing that was wrong.
That is precisely the core of the joint hypothesis problem, and it's the main line of defense for proponents of market efficiency when confronted with anomalies.
They can always argue it's not mispricing, it's just unmeasured risk.
They can, and often do. They argue that factors like size, value, book-to-market, perhaps momentum, or others might simply be better proxies for systematic risk than beta alone. The Fama-French three-factor model and later five-factor models are exactly attempts to build better asset pricing models that incorporate these dimensions of potential risk.
And if an anomaly seems to disappear or gets much smaller, when you use one of these more sophisticated multi-factor models to measure risk and expected returns,
then it significantly weakens the claim that the anomaly represented a true market inefficiency or a free lunch. It starts to look more like it was just risk compensation all along.
That really reframes the whole debate, doesn't it? It's not just a simple question of, is the market efficient, yes or no? It's deeply intertwined with the question, do we actually have the right model to measure risk and define what an efficient return should even look like?
It fundamentally complicates all the empirical testing. You can't prove inefficiency without assuming your risk model is correct, and you can't prove your risk model is correct without assuming the market is efficient in pricing those risks.
It's kind of circular.
It is, and this problem applies broadly. Remember Robert Shiller's famous work arguing that stock price volatility seemed way too high compared to the subsequent changes in dividends?
Yeah, he saw that as evidence of irrational market swings, right? Bubbles and crashes driven by emotion, not fundamentals.
He interpreted it that way, yes, as evidence against market efficiency. But his analysis also faced the joint hypothesis problem. His conclusion that volatility was excessive depended entirely on the specific mathematical model he assumed for how dividends should grow and how investors should discount them.
So critics could argue.
Critics argued that if Shiller's model of the correct dividend process or discount rates was wrong, then the observed price volatility might not be excessive or irrational at all. It might be perfectly rational and efficient if the true underlying process for dividends or required returns was different, perhaps more variable than he assumed. The whole variance bounds debate was intense and really highlighted how sensitive conclusions about efficiency are to the underlying model assumptions.
Okay, so the joint hypothesis problem is a huge hurdle for definitively proving market inefficiency based on return patterns alone. Are there other theoretical reasons, though, why markets might not be perfectly textbook efficient, even setting aside the model issues?
Yes, absolutely. The sources discuss several important concepts that suggest perfect efficiency might be theoretically impossible or unlikely in the real world. These often relate to the costs and dynamics surrounding information and the trading process itself.
Like what?
One really key idea is the paradox of costly information, which was formally pointed out by Sanford Grossman and Joseph Stiglitz back in 1980.
The paradox of costly information sounds intriguing. How does that work?
Their argument is quite elegant and cuts right to the heart of the matter. Think about it. If markets were perfectly efficient, meaning all information is instantly and fully reflected in prices the moment it exists, then there would be absolutely no profit opportunity available from gathering or analyzing that information. The price already reflects it. So why would anyone bother to spend resources, time, money, effort to acquire or produce information in the first place.
Right. If there's no reward, why do the work? Information gathering isn't free. Analysts need salaries. Data costs money.
Exactly. But now, here's the paradox. If nobody gathers information because there's no profit motive, then how does the information get into the prices? It wouldn't. Prices would become stale, they wouldn't reflect currently available information, and that would create profit opportunities for anyone who did gather the information.
Whoa. So perfect efficiency undermines the very incentive system needed to make the market efficient in the first place. It's self-defeating.
It's a logical paradox. It strongly suggests that perfect, instantaneous, costless efficiency is impossible in a world where information itself is costly to obtain and process. For the market mechanism to work, there must be some degree of potential profit available from trading on information. That potential profit is what incentivizes people to do the research and analysis that, in turn, helps make the market relatively efficient.
So the paradox resolves itself by suggesting markets can't be perfectly efficient. They have to be just inefficient enough to reward the information gatherers.
That's the Grossman-Stiglitz conclusion. Markets must deviate, at least slightly or temporarily, from perfect efficiency to provide the necessary incentives for information production and arbitrage. The actions of those trying to exploit these small deviations are what keep the market mostly, but not perfectly, efficient.
That makes a lot of sense. It implies a more dynamic equilibrium.
It does. And this idea also connects nicely to the role of noise traders, a concept famously highlighted by Fisher Black in 1986.
Noise traders. Who are they?
Noise traders are basically investors who trade for reasons other than processing fundamental information accurately to identify mispricings. They introduce noise into the trading process.
What kind of reasons?
Maybe they need cash for personal reasons, liquidity trading. Maybe they're chasing trends or acting on rumors or incomplete information. Maybe they're just reacting emotionally to market swings, buying in panics or selling in euphoria. Their trades aren't necessarily based on a rational assessment of fundamental value.
So they're creating buying or selling pressure that isn't driven purely by new information about the company's worth.
Exactly. They introduce demand or supply shocks that can push prices temporarily away from fundamental value. Now, Fisher Black argued, and the sources echo this, that the presence of noise traders is actually necessary for informed traders, the ones who do spend resources on information, to consistently profit.
Yes, sir.
Because noise traders create the opportunities. Informed traders can potentially buy assets from noise traders who are selling irrationally low, or sell assets to noise traders who are buying irrationally high. The noise traders' mistakes provide the potential profit that rewards the informed traders for their costly information gathering and analysis.
So paradoxically, these seemingly irrational noise traders who make the market deviate from fundamentals are actually essential for the process that allows informed traders to make the market more informationally efficient overall by trading against them.
It's a complex, almost symbiotic relationship in these models. But the key takeaway is that the very presence of noise means prices might not always perfectly reflect fundamental value. They can be pushed around somewhat by these non-informational trades, creating temporary deviations.
This sounds like we're getting into the real nuts and bolts of how trading actually happens day to day. Is this related to the field of market microstructure?
Absolutely, you nailed it. Market microstructure is precisely the study of how the specific mechanisms of trading, the rules of the exchange, the types of orders investors can place, the role of intermediaries like market makers or dealers, and crucially, differences in information among traders, information asymmetry, affect how prices are actually formed and how quickly information gets incorporated.
So it's about the plumbing of the market.
That's a great analogy. And it turns out the plumbing matters for efficiency. An early crucial insight here came from Bagehot, which was actually a pseudonym for Jack Trainer back in 1971. He explained how informed traders tend to profit at the expense of uninformed noise traders and how market makers, the dealers who stand ready to buy and sell, manage this.
How do market makers fit in? They're caught in the middle, right?
They are. They face what's called adverse selection risk. They don't know if the person wanting to trade with them is an informed trader, who likely knows the price is about to move against the market maker, or just a noise trader. To compensate for the risk of losing money to informed traders, market makers charge a bid-ask spread.
The difference between the price they'll buy at bid and the price they'll sell at ask.
Exactly. That spread is essentially the fee noise traders pay for the convenience of trading immediately, and it covers the market maker's costs and the expected losses to informed traders. Later, more formal models by researchers like Kyle in 1985 and Gloston and Milgram, also 1985, showed mathematically how this information asymmetry and the strategic behavior of informed traders, noise traders, and market makers lead to the existence of the bid-ask spread and influence how information gets revealed through the trading process itself.
And does information get revealed instantly in these models?
Not always. These models often show that information gets incorporated into prices gradually as informed participants trade strategically, try not to reveal their hand too quickly. The very mechanics of order flow and dealing with information asymmetry mean price discovery can be a process, not always an instantaneous event.
So, market microstructure adds another layer of realism, suggesting that due to trading costs, like the spread, information differences, and the mechanics of the market, prices might not always be perfectly efficient second to second, even if the information is theoretically out there.
Right. That bid-ask spread itself is a transaction cost. Even if you spot a tiny fleeting mispricing, the cost of trading to exploit it might wipe out any potential profit.
Okay. And finally, there's another whole field that offers a different perspective on why markets might deviate from perfect rationality and efficiency. Behavioral finance.
Yes, behavioral finance has become hugely influential. It basically draws insights from psychology and cognitive science to understand how real human beings, not the perfectly rational economic man of traditional theory, actually make decisions, especially under uncertainty, like in financial markets.
And the idea is that our psychological quirks can lead to market patterns that look like inefficiencies.
Precisely. Many of the anomalies we discussed earlier, like the apparent overreaction leading to long-term mean reversion, the value effect, perhaps driven by excessive pessimism about struggling companies, or even the IPO underperformance, maybe linked to initial over-optimism, seem quite consistent with well-documented psychological biases.
What kind of specific biases are we talking about?
Oh, there are many. The sources mentioning Kahneman and Reipe, pioneers in this field, highlight concepts like investor overconfidence. People tend to overestimate their own knowledge or skill or the precision of their forecasts.
Which could lead to
excessive trading, maybe taking on too much risk because you think you know more than you do. Another big one is herd behavior. Investors might just follow the crowd, buying when everyone else is buying, selling when everyone else is selling, even if it contradicts their own information or analysis. This can amplify trends and potentially push prices far away from fundamental value. Think bubbles and crashes.
Makes sense. Any others?
Loss aversion is huge. Psychologically, people tend to feel the pain of a loss much more intensely than the pleasure of an equivalent gain. This can lead to irrational decisions, like holding on to losing stocks for too long, hoping they'll recover the disposition effect rather than cutting losses rationally, or being too risk-averse after experiencing losses. There's also anchoring, where people latch on to irrelevant numbers, or confirmation bias, where they seek out information that confirms their existing beliefs.
So behavioral finance basically says, hold on, the standard EMH model assumes perfectly rational investors, but real people aren't always rational robots. And these systematic, predictable psychological biases could be the root cause of some of the observed market anomalies, like temporary over- or underpricing.
Exactly. It provides a plausible psychological mechanism for why inefficiencies might arise and persist, at least for a time. It suggests that anomalies might stem not just from issues with information flow or market mechanics, but from the very way our human brains are wired to make decisions under pressure and uncertainty.
Okay, this is fascinating. We've covered the theory of EMH, the anomalies that challenged it, the complication of the joint hypothesis problem, and then these other theoretical angles, costly information, noise traders, market microstructure, and behavioral finance, all suggesting reasons why markets might not be perfectly efficient in reality.
It's a complex picture.
It really is. But at the end of the day, for you, the listener, the practical question boils down to, can anyone actually do it? Can skilled professionals, with all their resources, time, and supposed expertise, consistently beat this arguably imperfect market in practice?
Right. This is often considered the ultimate litmus test. Forget the theoretical debates for a moment. Let's look at the real-world track record. If there are significant exploitable inefficiencies or patterns out there, then surely the people paid fortunes to find them. Professional money managers should be able to consistently deliver superior returns, right? Returns better than just buying a simple market index fund, even after accounting for risk and their own fees.
It seems logical. If the market is beatable, they should be the ones beating it. So what does the mountain of evidence, collected over decades now, actually show about the performance of these professionals?
The evidence is Well, it's remarkably consistent. And for many people who believe in the power of active management, it's frankly quite sobering. The overwhelming conclusion from study after study is that the vast majority of professional money managers, whether running traditional mutual funds, sophisticated hedge funds, or other actively managed portfolios, failed to consistently outperform standard market benchmarks on a risk-adjusted basis, especially after you account for their fees and trading costs.
The vast majority fail to beat the market. That's a really powerful finding, considering the size of the active management industry and the fees people pay. Let's dig into some of the specific evidence mentioned in our sources.
Okay. One of the earliest and most influential studies was by Michael Jensen, published way back in 1968. He looked at the performance of U.S. mutual funds during the 1950s and 60s.
And his conclusion?
It was pretty stark. He found that, on average, these actively managed funds earned returns that were actually less than they should have, given the level of market risk they were taking. And the amount they underperformed by was roughly equal to their expense ratios, their management fees, and operating costs.
So basically, before cost, maybe they roughly matched the market's risk-adjusted return, but after you paid their fees, they ended up underperforming.
That was the essence of it. They weren't adding value, on average, sufficient to cover their own costs. And this fundamental finding, Jensen's result, has been replicated and updated countless times over the subsequent decades, using different time periods, different types of funds, different methodologies. The basic conclusion holds remarkably firm.
The Princeton source and the Investopedia piece you mentioned, citing Morningstar data, they have more recent numbers on this.
Yes, they provide compelling, up-to-date figures that really drive the point home. They look at the percentage of actively managed funds that underperform their relevant benchmark index over various time horizons.
And what do those numbers typically show? I'm looking at some here. It seems pretty high.
It's consistently high, especially over longer periods that smooth out short-term luck. Over 10, 15, or 20-year periods, the percentage of active U.S. equity managers who failed to beat their simple benchmark index is typically somewhere in the range of 75% to 90%, or even higher, depending on the category and the exact period.
Wait, 75 to 90% failed to beat the benchmark? So only maybe 10, 25% actually managed to outperform over the long run after costs.
That's what the data consistently shows across most major fund categories. The Investopedia piece cited a Morningstar study, for example, showing that about 77% of active U.S. equity funds underperformed their benchmarks over the decade ending in 2019. Yes, performance can vary year to year. That same study noted 51% did manage to outperform in the single year 2023. But the long-term picture is what really matters for investors, and it's pretty bleak for active management on average.
So your odds of picking an active fund that will actually beat the market over the next decade or two are not great. Maybe 1 in 4, 1 in 5 at best.
Based on the historical data, yes, those seem like reasonable odds. And it gets worse. It's not just that most fail to outperform. The sources showed that the median actively managed fund often significantly underperforms its benchmark.
The median fund. So the typical fund experience is actually losing to the index?
Yes. Exhibit 6 in the Princeton source, for instance, show that the median large-cap active fund underperformed the S&P 500 index by nearly 2 percentage points per year over 10, 15, and 20-year periods ending in 2001. That 2% per year drag, mostly from higher fees and trading costs, compounds into a massive difference in wealth over long investment horizons.
Wow. So the average outcome for investors choosing active management isn't just failing to beat the market, it's actually doing significantly worse than if they had just bought a simple, low-cost index fund tracking the market.
That is the overwhelming empirical conclusion from decades and decades of performance data across millions of dollars under management. It's a really hard fact for the active industry to argue against.
And there's another critical finding from this research that makes it even harder, isn't there? Something about performance persistence.
Ah, yes, the lack thereof. This is another nail in the coffin for the idea that manager skill is easily identifiable and repeatable.
What does lack of performance persistence mean exactly?
It means that managers or funds who perform well in one time period, say they're in the top 10% for 5 years, are not statistically likely to repeat that top performance in the next 5 years. Past success does not reliably predict future success.
So a manager who looks like a star today might just be average or even below average tomorrow.
That's exactly what the data suggests. The sources provide some powerful examples. Funds that were the heroes of the 1970s often became the duds of the 1980s. The stars of the 80s frequently struggled in the 90s.
The Princeton source had a specific example from the tech bubble era.
A really striking one. It showed the top 20 performing U.S. equity funds during the bubble years of 1998-1999. They absolutely crushed the index, maybe tripling its return. Huge winners. But then, in the immediately following 2 years, 2000-2001, when the bubble burst, those same funds performed 3 times worse than the index. A complete and brutal reversal.
Wow. From heroes to zeros almost overnight. That's dramatic. What does this lack of persistence imply for investors trying to pick funds?
It implies trying to identify the future winners by looking at past winners is an incredibly difficult, maybe even futile exercise. Today's star manager might just have been lucky, or their particular style might have been temporarily in favor. There's very little evidence that superior performance persists reliably over time.
So as the Investopedia discussion notes, even if a small percentage of managers do manage to outperform over a given decade, selecting which ones those will be in advance seems to be largely a matter of chance, not skill that you can identify from their track record.
That's precisely the challenge. It's easy to identify the winners after the fact, but picking them beforehand is incredibly hard, maybe impossible on a consistent basis.
Okay. So if the vast majority of professionals, with all their resources, can't seem to consistently exploit these supposed market anomalies like size, value, or seasonal patterns to beat the market after costs, what does that tell us about the anomalies themselves? Does it mean they aren't really exploitable in practice?
That's a very strong argument made by EMH proponents, and it resonates with practical experience. The sources mention Richard Roll, who is not only a highly respected financial economist, but also had experience managing money. He famously commented on this exact issue.
What did he say?
He said, paraphrasing, that he had personally tried to trade on essentially every published academic anomaly and predictive pattern he came across, using both his own money and money for clients.
And his results? Did he make a fortune exploiting these inefficiencies?
His reported experience: I have yet to make a nickel on any of these supposed market inefficiencies. His point was that if an apparent pattern discovered in academic research doesn't translate into reliable profits after accounting for all the real-world frictions, transaction costs, bid-ask spreads, the market impact of your own trades, the speed at which others react, then it's not a true exploitable market inefficiency in the practical sense that would contradict EMH for most investors.
Why would these anomalies, which look statistically significant in academic studies using historical data, be so hard to actually profit from in the real world? What are the main hurdles?
Several major ones. First and foremost, as Roll implied, are transaction costs. These can be killers.
Like what kind of costs?
Brokerage commissions, obviously. But also the bid-ask spread we talked about. You always buy slightly higher and sell slightly lower than the midpoint price. And potentially market impact costs if you try to trade a large amount. Your own order can move the price against you before you even finish executing. Trying to trade frequently to capture small, fleeting patterns like short-term momentum or daily seasonal effects can easily rack up enough of these costs to completely wipe out any theoretical edge.
The Princeton source mentioned momentum strategies specifically in this context.
Yes, it noted that while momentum, buying recent winners, selling recent losers, often looks very strong in academic backtests on paper, it tends to generate disappointing results for actual investors, precisely because it requires high portfolio turnover, leading to substantial transaction costs that eat away the returns.
And the higher management fees charged by active funds also fall under this umbrella of costs that need to be overcome, right?
Absolutely. Those higher expense ratios of active funds compared to passive index funds represent a significant guaranteed hurdle that the active manager has to overcome every single year just to break even with the index before they even start trying to generate actual outperformance. It's a constant headwind.
Okay. Transaction costs are one big hurdle. What else makes anomalies hard to exploit? You mentioned what happens when they get published.
Right. That's often the kiss of death for an anomaly's profitability. Once a potential pattern is identified and published in academic journals or the financial press, especially if it looks promising.
Everyone jumps on it.
Exactly. It attracts the attention of sophisticated market participants, quantitative hedge funds, proprietary trading desks at investment banks, high-frequency traders. They have the resources and speed to quickly develop and deploy trading strategies to exploit the published pattern.
And what does their trading activity do?
Their collective buying and selling pressure tends to rapidly incorporate the information, or the pattern itself, into market prices. Through sheer competition, they arbitrage away the profit opportunity. The more people try to exploit an anomaly, the smaller and less reliable it becomes, often disappearing entirely.
So it becomes a victim of its own discovery. The market adapts.
Essentially, yes, the market learns. Another major challenge, especially with modern computing power, is the risk of data mining or data snooping.
Data mining, meaning what?
Meaning that if you analyze massive amounts of historical financial data, testing thousands or even millions of potential trading rules or patterns, you're statistically bound to find some patterns that look significant purely by random chance. They worked historically just by luck in that specific data set.
But they aren't real, repeatable economic phenomena.
Exactly. They're spurious correlations, historical flukes, artifacts of overfitting your model to the past data. These get mistakenly identified and published as anomalies. But because they weren't based on any underlying economic reality, they don't persist or work when you try to trade them going forward. Distinguishing a genuine persistent market feature from a random data mined pattern is extremely difficult.
Okay, so pulling this section together, even if we acknowledge that markets aren't perfectly efficient and these anomalies do show up in historical data, the real-world evidence from professional investor performance, combined with the practical difficulties of overcoming transaction costs, the market adapting to known patterns, and the risk of data mining, all strongly suggest that consistently exploiting these deviations to beat the market is an incredibly tough, perhaps insurmountable challenge for most investors.
That is definitely the dominant conclusion drawn from this whole body of research and practical experience. While the market might not be perfect in a pure theoretical sense, it appears to be remarkably efficient enough in practice that generating systematic, reliable outperformance, especially after costs, is exceptionally rare and difficult to achieve.
Right. So we've taken quite a journey here. From those first hints of random price movements over a century ago, through FAMA's formal EMH framework and its 3 forms, then the anomalies like size and value that challenged it, exploring the joint hypothesis problem and other theoretical explanations involving costs, noise, and behavior, and critically dissecting that powerful evidence from the actual track record of professional investors.
It's been a deep dive for sure.
And we even touched on potential refinements or alternative views emerging more recently. So where does all this leave us today? Is the traditional EMH still the final word, or is thinking evolving?
Well, EMH absolutely remains a foundational concept, a benchmark against which we measure things. But the sheer weight of the empirical findings, the anomalies, the behavioral insights, results from looking at higher frequency data has certainly led to more nuanced and evolving perspectives.
Like what?
For instance, with some more recent studies looking at daily or even intraday data, like the one by Sewell mentioned in the sources, have found statistical evidence suggesting that U.S. stock returns might not strictly follow a perfect weak-form random walk on those very short timescales.
So maybe not perfectly random minute by minute or day by day, even if longer-term returns look more random?
That's what some high-frequency data seems to suggest. There might be tiny, fleeting patterns or dependencies. This is partly why an alternative framework, the Adaptive Market Hypothesis, AMH, proposed by Andrew Lowe back in 2004, has gained considerable interest and traction in recent years.
The Adaptive Market Hypothesis, AMH. Okay, how does that view differ from the traditional sort of static, efficient or not efficient view of EMH?
AMH offers a more dynamic perspective. Instead of seeing markets as being permanently fixed in a state of either efficiency or inefficiency, the AMH suggests they are more like biological systems. They adapt and evolve. They cycle between periods where they are relatively efficient and periods where potential inefficiencies might emerge.
Cycle between efficiency and inefficiency. How does that work? What drives the cycle?
The idea, drawing heavily on evolutionary biology and psychology, is that profit opportunities, inefficiencies arise due to changes in the market environment, new technologies, shifting regulations, or evolving investor behaviors and biases. These opportunities then attract competition arbitrageurs, informed traders who try to exploit them.
And that competition?
That very competition acts like natural selection. It drives out the easiest profits, incorporates the new information or pattern into prices, and pushes the market back towards a state of higher efficiency. But the environment is always changing. New information flows arrive, investor sentiment shifts, new behavioral biases might become dominant for a while, creating new potential opportunities. It's seen as a continuous, dynamic process of adaptation, competition, and changing levels of market efficiency.
So under AMH, inefficiencies can exist, but they aren't necessarily permanent flaws. They're more like temporary conditions in a constantly changing ecosystem.
Exactly. They might be transient, unpredictable in their timing and duration. Exploiting them consistently over the long haul remains incredibly difficult because the market system itself is constantly learning, adapting, and competing away any obvious edge. As soon as a profitable strategy becomes widely known or used, its profitability tends to decay.
That sounds like a more realistic description of how markets might actually behave. Is there empirical work that specifically tries to test the AMH, say, in U.S. markets?
Yes, there is growing research in this area. The 2019 study by Canyu Huang, mentioned in our sources, is a good example. They looked at daily S&P 500 index data over a long period, from 1988 to 2018. They used statistical models to test whether daily returns were predictable based on past returns, comparing a model that can find patterns, an ARIMA model, against a simple random walk model.
And what did they find? Did it support the random walk or something else?
The results were quite nuanced and interesting, actually lending support to the AMH idea. Using one standard way of testing predictability, they found that the ARIMA model did statistically outperform the random walk model. This suggested that, based purely on historical daily price data, the U.S. market wasn't strictly weak-form efficient during that period, similar to what Sewell found. There seemed to be some short-term predictability.
Okay, so evidence against strict EMH, at least on a daily basis.
Right. But then they did something clever. They reran the tests using different ways of measuring forecasting errors. They incorporated the behavioral idea of loss aversion, essentially asking, what if investors care more about prediction losses, getting the direction wrong when the market falls, than prediction gains of the same size?
How did that change things?
When the statistical test was adjusted to reflect this psychological perspective, penalizing downside prediction errors more heavily, the results changed. The evidence for consistent predictability weakened, and instead they saw patterns that looked more like the AMH periods where predictability seemed to emerge, followed by periods where it disappeared, consistent with the market adapting over time.
Wow. So depending on how you incorporate potential investor psychology into the statistical test itself, the market's behavior might look less like a stripped random walk and more like a dynamic adaptive system.
That's what their studies suggested. Their conclusion was basically that the U.S. market probably isn't strictly weak-form efficient on a daily basis, according to standard tests, but its time-varying behavior might be better described by the adaptive market hypothesis, where psychological factors, competition, and adaptation interact to create constantly shifting degrees of predictability.
That feels like a much more dynamic and maybe more realistic picture than the old binary choice of just efficient or inefficient.
It certainly tries to acknowledge the complexity of real-world markets and integrate insights from traditional finance, behavioral economics, and even evolutionary theory. But importantly, even within this more dynamic AMH framework, the practical implication for the average investor often remains quite similar to the EMH conclusion, which is that while temporary pockets of inefficiency or opportunity might theoretically exist from time to time, they're likely to be fleeting, incredibly hard to identify reliably before they disappear, and often too small or costly to profit from consistently after accounting for transaction costs and the fierce competition from highly sophisticated players. The adaptive nature itself makes sustained outperformance difficult.
Okay, this has been an incredibly rich and really insightful deep dive. We've covered a huge amount of ground.
We really have.
We journeyed from those very first glimmers of random-like price movements over a century ago with Batchelor through the formal development of the efficient market hypothesis by Fama and Samuelson and its different forms. We examined all those compelling anomalies, size, value, seasonals, IPOs, mean reversion that seem to contradict the simple story.
Explore the crucial joint hypothesis problem.
Exactly. And looked at other theoretical reasons for deviations, costly information, noise traders, market microstructure, and the impact of behavioral biases. Dissected that really powerful, sobering evidence from the real-world performance of professional money managers. And finally, touched upon this more modern, dynamic perspective of the adaptive market hypothesis.
We've seen how this simple yet profound idea about market efficiency has been rigorously tested, fiercely debated, challenged, and refined over decades and decades of research.
So let's try to bring it all home. Thinking about everything we've unpacked, what is the most critical bottom line takeaway from this wealth of information for you, the listener, especially when you're thinking about your own approach to investing, particularly in a major market like the U.S.?
Well, look, while the academic debates are fascinating and clearly ongoing, and the evidence certainly suggests markets aren't perfectly efficient in some strict theoretical sense at every single microsecond, the overwhelming weight of the empirical evidence, especially that incredibly consistent data showing the failure of the vast majority of professional investors to beat simple benchmarks after costs over meaningful long-term periods, points towards a very powerful practical conclusion.
And that is?
That consistently beating the market on a risk-adjusted, after-cost basis is extraordinarily difficult, bordering on impossible for the vast majority of investors, individuals, and professionals alike over the long haul.
The market, even if imperfect, seems to be remarkably effective, maybe surprisingly effective, at incorporating information and making it incredibly hard to find systematic, reliably exploitable mispricings that stick around long enough for most people to profit from.
That really sums it up well. The cumulative evidence, particularly that stark performance data, strongly suggests that for most individuals trying to outperform the market through active strategies, picking individual stocks, trying to time market swings, or even just selecting actively managed funds that claim they can do it, is, statistically speaking, a low probability endeavor.
And one that's likely to cost you more.
Likely to cost you more in higher fees, more trading costs, potentially more taxes, and maybe even missed market returns during periods when your active bets go wrong than you could realistically hope to gain, compared to a much simpler, low-cost approach.
So the strategy that seems most aligned with all this evidence?
The sources generally converge on this. For most investors, a strategy of low-cost passive investing, like using broad market index funds or ETFs, those exchange-traded funds that just track an index like the S&P 500, is the most sensible approach. The goal isn't to beat the market, but to simply capture the market's overall return, reliably and at the lowest possible cost.
It's the approach that basically accepts the market as efficient enough that trying to consistently outsmart it is likely a losing game for most people. Of course, you always have the Warren Buffett counterexample.
Right, the Oracle of Omaha. He's the exception, often cited, proving that extraordinary skill, patience, and a disciplined value approach can generate massive long-term outperformance. But the crucial point is that his success is incredibly rare and has proven exceptionally difficult for others to replicate consistently. He's the exception that highlights how hard it is for everyone else.
And those anomalies we discussed, they're intellectually interesting, they push our understanding forward.
Absolutely. But as Richard Roll's experience suggests, and as the AMH framework implies, turning those academic findings into reliable after-cost profits in the hyper-competitive real world is a completely different and much harder challenge. They often disappear once discovered, or the costs eat the profits.
Okay, so let's leave you, our listener, with a final thought to mull over after this deep dive. Considering how incredibly difficult the evidence suggests it is to consistently beat the market, considering the professional track record, and considering that the market itself might be dynamic, constantly adapting, cycling between periods of relative efficiency, as the AMH suggests, does it make sense to spend your valuable time, your mental energy, and your hard-earned capital trying to predict its next move or find that elusive edge?
Or is there perhaps a more efficient use of your resources? Maybe focusing on things you can control, like your savings rate, your asset allocation strategy, keeping costs low, managing your own behavior, and taking a long-term perspective by simply embracing the market's return through a broadly diversified, low-cost approach.
What's the most efficient path for you based on everything we've unpacked today? Something to think about.
A fundamental question for every single investor out there.